We also are paying special attention to shares of Alibaba. Now, we look at these shares, they're under some pressure. The company reported its results, somewhat mixed results for the fourth quarter. So to take a closer look at this name and some of the others that are similar in the realm of Chinese stocks, it's down 6.6%. Anthony Sassine's with us of Crane Shares, and Engin Kose is with us of Ralliant. Thank you both for being with us. So, Engin, I'll start with you. Some of your thoughts, big picture here on the likes of Alibaba getting hit today. Why is that, in your opinion?
Well, the results were mixed and not as bad as the news headline of the 86% down in net profits. We recognize that drop in net profits was due to a markdown of public company investments of the Alibaba they made a year ago. For instance, a year ago, their numbers were better because of those investments. So the non-GAAP numbers is only down 5% for quarterly year over year. However, there is growth in revenue beat. Overall, we believe Alibaba and the companies like Alibaba, overall Chinese internet sector are showing good growth prospects in the long run. They have strong balance sheets, strong cash holdings. So we still keep our positive view for the long run of these companies.
So still positive for the long run. Really interesting. I mean, 1 year it's down about 7.5%. Curious to hear what you have to say, Anthony, when you saw the numbers. What say you about a name like Alibaba?
I mean, mixed results for sure, but it's actually showing better quality, right? Especially that Alibaba is in a transition period right now. I mean, 7% revenue, 14% net profit growth, that's not too bad. And returning to shareholders 15 billion through share buybacks and dividends. That's good quality numbers, but these are not the numbers that we're used to with Alibaba. And Alibaba is in a transition now, and most of its businesses outside of e-commerce, they're in a double digit, and AI is an actually triple digit growth. In the fiscal year 2024, which ended in March, but the e-commerce continue to struggle, and that's a little bit reflective of the weakness in consumption and consumer in China. Despite us seeing online retail growing double digits consistently, we still haven't seen the consumer come back in a big way. They're buying smaller ticket items.
Mm-hmm. And look, Anthony, I mean, we've all been watching this, but you also noted, right, the numbers they've been seeing. They have buybacks, they have dividends going maybe to the Hong Kong, maybe announcing that it will be there and listing there in Hong Kong. Would you be comfortable buying Chinese stocks overall? There are some people who have no problem with it, and others who get a little nervous because they just look to the premier of China and get worried about some of these names. At the same time, you have the Biden administration putting levies on Chinese clean energy products that are coming our way. Some of your thoughts on the big picture, Anthony, of Alibaba and the likes of some of the other Chinese stocks. Are you in or out?
Always in. You always have to have Chinese stocks and Japanese stocks and European stocks and US stocks. You have to go through cycles. The picture is not very pretty, and right. What we're here, the headline news is also has a lot of noise. But the fact is, KWEB is up close to 30% since February lows, and they're positive year to date, outperforming S&P and Nasdaq. And you look at valuation, very cheap, and positioning very cheap. And then, as you mentioned, Alibaba stock will be converted to primary in Hong Kong and be admitted into China, HK Connect, which could be a big boost. And if you look, we haven't talked about Tencent. Tencent number were a lot more impressive today, right? And Tencent is a broad economy. They have gaming, they have ad revenue beat, which is very encouraging for me, seeing actually businesses spending on ad revenue. So Tencent is up 7% today because they had better results. Alibaba is in a restructuring, but you always have to have Chinese stocks, especially in time like today, where Chinese stocks are really cheap, U.S. stocks not so cheap.
Okay. Yeah, Engin, what do you think?
Yes, I completely agree. So one aspect is the cheap valuations of China equities. For example, if you look at Baba forward P ratios, it's significantly lower than the peer group average. Also, on the macro side, we believe the Chinese government stimulus shown effect on the manufacturers. on the producers. So the most recent PMI numbers from China came surprisingly good, and the growth was above expectations. We will see the Chinese government will push more stimulus to the consumer side, simply because it's the only logical solution, and that will definitely create tailwinds for companies like Alibaba.
Right. Well, you both sound positive, that's for sure. Anthony Sassine and also Engin Kose of Ralliant and Anthony of Crane Shares, thank you both for being with us.